Who wants to take it first? What were your initial impressions? Were we surprised? Not surprised?
Well, I'll jump in. Look, I expected Kevin Warsh to come out swinging, to be rather hawkish. So that's when the first thing that we saw was the FOMC statement. I was actually a little bit surprised. Most of the text of the FOMC statement, at least on my read, was rather dovish. He was focusing, or I should say the committee itself was focusing on supply side factors that are contributing to inflation. The committee was focused on the fact that the labor market is relatively, unchanged.
Yeah.
It was not saying that there's any progress or any strength in the labor market, for example. The one hawkish line in the statement is just that the Fed is committed to its 2% inflation target, basically. So that took me a little bit by surprise, but the dots really do all the talking that we needed to see today.
The ones that are there.
That's right. The dots that we received today spoke volumes, said far more than the FOMC statement really ever could. And obviously that's what markets are indexing on.
Andrew?
Yeah, it was certainly a very hawkish dot plot and certainly a very hawkish press conference. I guess the question for markets is still, is this a lot of bark so you don't actually have to bite later? Basically, are you trying to tighten financial conditions now? Are you trying to threaten with rate hikes, which will ultimately combat inflation more than if you come out and say, and it also gives you credibility. This is your first press conference. You need to come in. You don't want to seem like a puppet of the administration, so you come out and you talk extremely hawkishly. Are you going to follow through on it? That's still to be determined, but I think you did your job in the first press conference by giving yourself some credibility. Now we'll see. Again, 6 weeks from now, are you still going to be talking this way? I think right now it's easy to talk, and obviously risk assets are kind of falling on this news. But I'd like to see if they actually follow through.
The reaction in the front end of the bond market, 16 basis points higher on the 2-year. Does that surprise you, and do you think that holds?
Yeah, no, it certainly surprises me because I wasn't expecting there to be 8, 9 FOMC members who were projecting a hike as the next move. And there was talk of 3 or 4. And so I think that's where the big surprise was. And look, as a bond investor now, you have to kind of increase that probability that is the next move. Again, this is a very divided Fed. You can see that with half the committee thinking hikes and half the committee thinking cuts, like there's not very often that we're at that place. And so I think that time will tell. I do think that there's some tailwinds that are going to help new chair Warsh, which is, look, oil's just fallen $35. 6 weeks from now, when we get a couple of CPIs, that things could be going your direction where headlines coming down because gas prices, oil. And so you can say this now, and then look, you have some time to kind of figure it out without actually hiking.
Although we did see a little bit of shakiness after the president said if Iran doesn't agree to those terms, that he's going to go back to bombing them again. We did see that reflected in the markets and in the Brent and WTI a little bit this afternoon. Stuart, Warsh also said there was limited discussion about a rate cut today with one proposal. Do we think that was his proposal? Do we think he was a limited discussion?
No, I don't think that he was offering anything in terms of cuts. When his real opportunity today was behind that pulpit. It was behind that podium, using the bully pulpit to his best advantage. And he put basically no emphasis on the labor market at all. Anytime he brought up the remit from Congress, he did not bring up a dual mandate. He focused entirely on price stability. So I don't think that any of the discussion around the table by anyone with regard to cuts was being encouraged by Kevin Warsh today. I think that we saw pretty vintage Kevin Warsh behind the podium, and I imagine that he was the same way in the room. What I'm a little bit interested in, and Christina, this is to your point, we have seen energy prices coming down pretty substantially. Andrew, you mentioned this as well. When we see the move in markets following both the FOMC decision and the press conference, we saw long-term rates floating up a little bit, but we saw break-evens falling. So literally throughout the entire curve, they're viewing this as hawkish, but not necessarily hawkish. I guess just real rates are still rising throughout the curve. Is this indicative of just some sort of a regime change everywhere? I mean, I'm interested to hear your thoughts, Andrew.
No, it's a good question. I think one of the things for the bond market for real yields is that when you talking about the amount of communication we're going to get from the Fed, it seems like if they're going to be less communicative, then volatility is going to be higher. But I think that Chair Warsh's sole focus on inflation, and this is like inflation's a choice, all these things should certainly be, compress break evens and give bond investors the confidence, look, short-term pain, long-term gain as far as where yields can go. If you basically can speak hawkish now and say you're going to combat inflation, that's good ultimately. And you're obviously seeing it in the 30-year where yields are actually down despite the move in the front end. Like, this is one of the biggest flattening days we've seen in some time. I think that break evens are ultimately going to follow oil in the short term. If this truce with Iran is longer lasting, then I think you'll continue to see break evens come down. And again, they've come down 50, 60 basis points at the front end just in the last month or so, and that's all related to oil. And I don't think we have that big of an inflation problem if the war in Iran is over and oil is going to resume its kind of,
March.
Yeah. So it's a big if. Exactly. It's a big if. And I think this would have been a much tougher meeting for Chair Warsh 3 weeks ago, 4 weeks ago, when all of a sudden oil was at 110, 115. Yeah. I think that's a situation where, we didn't know if oil was going to 150 next or 200. The Strait of Hormuz is still closed, but oil's at $75, $76. I think it's easy to talk like this now. This could have been a much tougher meeting just a few weeks ago.
When you look at their approach, and Warsh saying that he's likely going to be less communicative, and you have all these, what are they, not working group, task force, so many task force to talk about the communication. Is there a risk, and one of our colleagues posed this question, but is there a risk that if the Fed, to your point, is communicating less in a time of market volatility, that silence is going to get filled somewhere, and they could lose track of the narrative and almost be less influential if other people are filling that void that they would expect the chair to fill?
I'm not entirely that worried. From a monetary policy making perspective, communications as a tool for conducting monetary policy is asymmetric. It's really valuable if you're constrained by the zero lower bound and you're trying to talk down the curve. You're trying to give some sort of a credible commitment that you will not raise rates. Instead, we're in this moment where risk is somewhat two-sided. Policymakers are divided on whether they want to stay still at least through this year and then deliver some sort of a cut or hike before year end. And when that's the case, offering any sort of forward guidance is just unnecessary hand binding by the Fed. And so I'm not sure they're entirely worried about losing control over the narrative. Instead, I think that at least it sounds like from Kevin Warsh, it's a good thing to remove oneself from crafting the narrative, to let markets digest information as it becomes available, and the Fed will deliver the policy that it thinks is necessary and appropriate. And the objective of guiding markets' expectations is less valuable than establishing, let's say, independence, both from the market and from political pressures.
Andrew, what do you think? Because you're someone in the markets. How are you going to, is there an information void now? And if you think there is, how are you going to determine the path of Fed policy ahead if you have that lack of guidance? Are there other signals you're going to pay more attention to?
No, look, I think you'll read more of the speeches that are kind of intra-meeting and see what different FOMC members are saying. I think Stuart makes a great point where a lot of times the Fed is talking for the sake of talking, but you don't have much to say. It's like if we're on a pause for 6 or 12 months and you're just doing this press conference, I do think it's going to be tough to kind of walk it backwards, and then just what are you going to have, like an impromptu press conference every time you hike or cut? It's going to be tough to keep those things quiet, and there's always things that are going to kind of leak through the system. So I think that it's something that markets crave information, and as you were saying earlier, like there's going to be, if there is some information void, people are going to look to somewhere else. Again, there's a task force. We'll see, if the task force ultimately decides this is in the best interest, then maybe we keep them. I think that, are you going to go to every other meeting? Is it going to be, what are you going to do if not, at every meeting? It's kind of, obviously we used to be there, but I think that it ultimately may end up staying in the long run, but we'll see.
So to clarify, I just want to recap because we haven't actually said it. So in his prepared remarks, he announced 4 task force, one on communications, one on the Fed's balance sheet, one on the use and reliance of existing data sources, and one on productivity and jobs. So I'm sorry, you were going to say something.
Well, it's interesting that you bring up the idea that, yes, there are all these task force that are going to be rolled out to perhaps offer some additional information.
Yes, if you had prepped a Kevin Warsh Fed drinking game and task force had been on it, we would all be in very bad shape right now.
That's right. Task force was our Price stability would have been another,
Yes, correct.
would have been on the bingo card also. So we're going to get some additional information from these task force. Andrew, to your point, that in the absence of formal communications from the FOMC, markets are going to be looking for that information elsewhere. The thing that I'm a little bit hung up on is that maybe that information doesn't come from a person. Maybe we go back to circumstances where that information is provided by the data. That information is provided by evolving global conditions. And I think that that's something that would definitely be welcomed by the Fed. But where that intersects with these task force is interesting. If you don't entirely know where the Fed is looking for its inflation information, because that's evolving with these task forces, that
is it like attorneys general task force? Anyway, continue. Yes,
it becomes a little bit more complicated to get any sort of insight into the Fed's reaction function or guidance for policy. I think that instead we're going to need to work the other way. As economists, at least in my seat, we're going to need to work the other way. As markets evolve, as the data evolves, what are we thinking about the intersection of, let's say, markets and the real economy? So over the last several months, we've seen some tightening of financial conditions in the form of higher rates, and we have at least thought that those higher rates would do some of the heavy lifting for the Fed. Mm-hmm. The Fed wouldn't necessarily need to deliver cuts because we've already seen some of the move in markets, and that would restrain economic activity. And so it seems like that would be a way that we might have to consider both economic evolution going forward and financial markets evolving going forward.
Andrew, were you at all concerned? I don't know. I guess I've covered Washington long enough. I always think of that, if you torture the numbers long enough, they will confess adage. And when I heard them doing a task force into, quote, the use and reliance on existing data sources, any concern there that lends itself to manipulation if that were to be changed too drastically?
And Chair Warsh has spoken before he came into office about some of the inaccuracies in the inflation data. Not inaccuracies, just some of the quirks with the inflation data.
Yeah.
When you look at using OER for housing instead of some other metrics where you have Zillow rent index, which is showing one handle year-over-year inflation in rents, and apartment list is showing negative, but owner's equivalent rent is showing 3.5. So I think some of these things are a way to actually, show that the inflation number is actually lower. There's metrics out there like Trueflation and stuff that are showing a much different inflation picture, but we know we do have an inflation problem right now. My view is that it's just solely reliant on the move in oil, and if oil's coming down, then it'll solve itself. And that, as Stuart mentioned earlier, like this is not a demand-driven oil shock. This is a supply shock. The central banks, the Fed historically doesn't respond to those. Obviously, the ECB did. And if every other central bank in the world does respond to that too, ultimately you might have a weaker dollar and then inflation is going up. So that can actually cause more inflation too. But I think that it's something over time. We're going to see some changes to the inflation data. I think some of that's welcome, though. I think some of it's a little bit archaic. We have more real-time data sources we can be using. So I think that's something that markets would welcome.
You follow the housing market as well, and there was some talk today about the transmission mechanism and the transmission of monetary policy. Do you think that we're in a restrictive world where these higher rates that we've now seen for a couple of years are actually working their way through the real economy?
Yeah, look, the one area that obviously higher interest rates impacts the most is in the housing market. And you've seen that with home building. You've seen that with home sales. Existing home sales, new home sales are quite depressed. And that's for good reason. Look, there's a lot of people that have these 2.5% to 3.5% mortgages. For them to move into a house that's 50% more expensive in price, but also has kind of doubled the mortgage rate, just doesn't make sense. And so I think you're seeing those people respond accordingly. I think, look, over time, I think there was this view a couple of years ago where I think even like Quicken Loans had something where like buy the home, date the rate. Well, mortgage rates have now been at 6+% now for a number of years in a row, and so I think that's
that's too much data. You got to commit at some point.
So I think that look, the housing market is weak as it should be. But in the construction business, there's one thing that actually is filling that void a little bit, which is data center construction. So I think that's helping on the construction side fill a void that would typically be there for years until rates came down.
You've led very nicely into my last question, which, Stuart, I'm going to lob over to you. Warsh was actually also asked about AI. And he said it's the most important change in the economy and business we've had in our adult lives. Do you agree with that? And where is the Fed's role in any of this?
Look, I think that a lot of the supply, I I should say, a lot of the productivity gains that folks are expecting from AI, I think, are probably a little bit overstated. I think that the way that he danced around Nick Timiraos's question, specifically about the difference between the inflation pressures from the AI infrastructure build out and any potential disinflationary forces that come from those efficiency gains from the implementation of AI, speak volumes. He did not want to necessarily answer the question directly, because to do so would require him to get even more hawkish in a moment where he is tying American prosperity to this idea of AI implementation, which he said is even a shorthand for American innovation. So it's something that he's trying to handle really delicately. And because of that, I think that we're not going to get anything on the Fed policy front tied to AI.
All right.